Hello, this is Ernest Burley Jr., your certified financial planner professional, your chartered financial consultant, your NFLPA registered player financial advisor, your author of two books on money management, Money Management Easy as 1, 2, 3, and Money Management from Grade School to Grad School. These books are being used across the country to help financial planning principles, money management principles, and insurance concepts be taught to children, youth, and adults. So I appreciate those who are doing that now. There are some churches that use it for their financial freedom programs and things of that nature, and individuals who are doing it and giving the books to their relatives. So I really appreciate that. Keep that going. Go to Amazon and just sell them out. Tell them we need more books. So I thank you for that. I ask that the remainder of you do the same thing. Okay. I'm also an insurance agent with over 30 years experience in the industry and over 25 years in business. I'm an investment advisor representative. I hold the Series 6, 63, and 7, which allow me to offer securities products to clients across the country. I really love helping clients all across the country. And I have clients from the north to the south, from the east to the west. So state lines don't confine or restrict Burley Insurance and Financial Services NWA from helping clients across the country. Now, I mainly focus on wealth management, also investing, so IRAs and rollovers, 401k plans, things of that nature, asset protection, so protecting what people have accumulated, as well as asset growth, so trying to grow in a strategic fashion the assets that you have access to, and also financial planning, whether it be basic financial planning or comprehensive financial planning, all different types of life insurance and other types of insurance plans. So auto insurance, homeowners insurance, disability, life, long-term care, business policies, contractors, professional liability, churches, rental properties, jewelry, boats, the whole 9 yards. So all different types of insurance we help clients with, and also athlete management. So on the NFL side, I'm an NFLPA registered player financial advisor. On the NBA side, I'm an NBPA certified player agent. So the purpose of the podcast, I want to jump into this bad boy, is to educate, to enlighten, and empower you with clear, objective, unbiased information so you can make some great decisions for yourself and for your family and those who you're connected to. That's what it's all about. Okay. So let's jump into this podcast. The title of this podcast is Can Investments Beat Insurance? Again, can investments beat insurance? And I get this question from time to time. I don't get it a lot, but I do get it from time to time. And I'm just going to give an example. So I've had people inquire and they'll say something like, hey, is there a regular investment that I could purchase and grow it like 8 to 10% a year, right? Instead of like, putting money into a life insurance policy. So like, hey, if I'm paying $100 a month, instead of doing that, let me just pay $100 a month or $1,200 a year to an investment that's making 8 to 10% a year. And let me do that instead of getting a life insurance policy, right? Or if it's $200 a month or $300 a month or whatever the number is, I just did 100 to make it easy, right? So there are a few problems with that proposed solution. The first one is that there's no investment that guarantees 8 or 10% or whatever. It just doesn't exist, right? So it just doesn't exist. Like, don't let someone like tell you something like that, because I've come across that where someone's told me that someone's told them they can guarantee them this amount of money. And I was like, well, let me see the paperwork. I'll put my money in it. And of course, I never get the paperwork. Don't let someone, jip you out of your money like that. Okay. But now, hey, if you're in a good diversified portfolio, you could make 8 to 10% a year or even more. You could, but it's not guaranteed. You can do well in the market if you have a great diversified portfolio, you catch it, the right investments at the right time, but there's nothing guaranteeing that. Um, so that's the problem. It's no guarantee. The market is very volatile, which the past couple of years have shown us that, right? The market is up and down and up and down. It's very volatile. So yeah, there's nothing guaranteeing you to earn 8 or 10% a year in the market. So that's the first problem. Okay. The second problem is that no investment can beat or match insurance because of the large potential insurance benefit that is immediate, right? versus you'll have to wait a long period of time for your money to kind of build up to what the potential payout would be for an insurance policy. And that's any insurance policy. My focus today is life insurance because I normally get this question on life insurance, but even auto insurance, homeowners insurance, business policies, church policies, contractors, professional liability, long-term care, disability. I don't care what insurance policy it is. If you're trying to save that premium every month instead of putting it into instead of like paying it to the insurance company, you're putting it into some type of savings account or investment account, it doesn't match or equate to the benefit. So here's what I want you to do. Take a look at what I'll just say a homeowner's policy. Say you have a $500,000 house and you're paying $2,500 a year insurance on it. Okay. You may say, man, that's a lot of money. Well, look at what the potential payout is for that policy immediately, right? $500,000, that's how much your house is insured for. So if it burns down or blows away or a tornado rips the roof off or whatever, the insurance company has to pay the $500,000 to replace the house. That's what the coverage is for. But that's not all. Also, there's another coverage on there called increased dwelling extension or other structures. Different companies call it different things, but it's like an additional 10%, and some companies have this additional 20% of your building coverage. So like a lot of companies I write with, it's an additional 20%. So in addition to the 500,000, there's another $100,000 of coverage for other structures that are on your premises, like fencing, and if you have an in-ground pool or a gazebo or a shed on a slab, something that's permanently attached to the land but not attached to the house. Okay, so that's more coverage, another $100,000 or $50,000 at least for other structures on your premises. Then what about your personal possessions inside the house? Most policies, most very good policies, have at least an additional 75% of your building coverage for contents. So 75% of $500,000, that's another $375,000 for your personal possessions. And even the most basic policies give you at least 50% of your content of your building coverage for content. So that's another $250,000 for personal property just for a basic policy. Most policies, it'd be 75%, which is $375,000, right? Then you have liability coverage built into the policy too. That's a minimum for that is $100,000. I normally write a $500,000 for liability coverage on policies because people get sued. It just happens. Someone injures themselves on your premises, someone drowns in your pool, someone slips and falls in your house, whatever. Your dog bites something, liability. Okay, so, and I recommend people get an umbrella policy. I've talked about umbrella policies. It gives you an additional $1 million over and above your basic liability policy for your auto, for your home, for your rental property. So, and they're only like a couple $100 a year for an additional $1 million of coverage. So you definitely want to look into something like that. But in either case, look at all that potential payout from the insurance company for your $2,500 premium. We just talked about $1 million that could go poof just like that. $500,000 for the house, $100,000 for other structures around on the premises. That's $600,000. $375 for your contents. That's $975. Liability. It just goes on and on and on. So just look at it that way. Now I'm focused on the life insurance today because that's what I normally get an inquiry about. People don't often ask about putting money away to save for an auto accident or the homeowner's insurance policy. It's normally life insurance. So let's just say, for instance, someone does $100 a month. I ran some quotes. I have it written down here, right? I'm not going to show you what I have it written on. It's just chicken scratch, but it came from the computer. So a 50-year-old female that's in good health can get a $100,000 policy, a permanent policy, which means the rate won't change, the coverage won't change, for $100 a month. Now, if it's term, they can get that for like $30 a month. I mean, term is really cheap, but after 30 years after that term, the rate's going to go up to $1,100 a month. How about that? Instead of just $100. And we talked about this, the term versus permanent coverage. I'm not going to get into the weeds on that, but yeah, a 50-year-old female in great health can get a $100,000 policy for $100 a month. That policy would be the same premium, whether she's 60, 70, 80, 90, 100 years old, be the same premium, right? Now, what if you say, hey, instead of putting this $100 a month into life insurance premiums, let me save $100 per month or $1,200 a year. I already did the calculation. If you do that and you earn 10% a year, if you happen to earn 10% a year, it still will take you over 22 years to get to $100,000. After 22 years of earning 10% a year on your money of $100 per month, it's still only going to be a little over $96,000. Still won't be $100,000, right? So the main big problem with trying to out invest insurance is the immediacy of it versus you having to wait a long time to try to accumulate the same benefit that you would get from an insurance policy. So after that first year, you have $1,200. If something unfortunate happens and the person passes, you're going to just get your $1,200. And if you made 10%, that's 120 bucks on top of that. Okay, that's 1,240, right? Or whatever it is, 120 plus 1,200, 1,220. 1320, whatever it is. I think it's 1320. That's not 100,000, right? And even if you say, hey, well, 10 years, that's 12,000. Say if you even doubled your money in 10 years, that's 24. And I think I've done this before on another podcast. So I'm not going to beat it up, but I just want to drive the point home that let's not have that conversation anymore because you can't out invest insurance. And it's not like, oh, Ernest is just Mr. Insurance Guy. No, it's just the numbers, right? I'm a numbers guy. So just look at the numbers. You can't out save the insurance because here's another added bonus. A lot of people, there are millions of people putting money into the pot. So it's not just your $100 per month. It's someone else putting $100 a month, someone else putting 50, someone else putting 200, someone else putting 300, because different people have different premiums. So all the money is going into the pot, and then the pot is big enough to pay out the claims as they come up. So you have your auto insurance pot, your homeowner's insurance pot, your business policy pot, your life insurance policy pot, your long-term care pot. So best believe, I mean, things are happening every day. People are getting into accidents every day, wrecking cars, right? Homes are having problems every day. Trees falling into houses, kitchen fires, water damage, all that's happening. So money is coming out of that pot every day, right? People are dying every day. Money's coming out of the pot every day. But another big reason you can't out invest insurance is because you have a lot of other people's money going into the pot. So if something unfortunate happens, you have all of that money in the pot, the access to it to pay the claim based on what your policy is, of course. So if you have $100,000 policy, boom. If you have $100, you pay that premium and the person passes the next month or the next week or the next day, $100,000 versus if you put that $100 in a savings account, you have $100. So I want you to really look at the math. Just let's not have that conversation anymore. Okay. And last but not least, here's another point on that. And I'm focused on the life insurance right here, even though I gave you an example of homeowners insurance. I just wanted you to know that concept works for all insurance. You can't out invest insurance. So here we go. Last but not least. So with life insurance, the benefit is not taxable, but if you put the money into an investment, the gains that you make on that investment will be taxable. So either the money going into the investment will be taxable or the money coming out of the investment will be taxable, depending on what type of investment it is. So that's that, right? If you put away $10,000 and you made $4,000, well, guess what? That 4,000 is gains. You got to pay taxes on that gain. But the life insurance policy, the $100,000 payout is not taxable because it's life insurance. Okay. So that's it. Those are the main points. I just wanted to go over those points. I'll recap them for you. The first one is there's no, people ask, can I just put it away? And they always throw out that figure, make 8 to 10% a year, or 10% a year on the money. There's nothing that guarantees you're going to make that money. That's point number one. There's no guarantee for you to make that kind of money. Of course, you could make good diversified portfolio, but you'll be up and down in the market because that's just the way it goes. But there's nothing that guarantees it. That's point number one. Point number two is you have to save over a very extended period of time to even get to what the potential insurance benefit payout is versus the insurance benefit payout is immediate. Like the next day it's applicable versus your $100 or whatever your monthly premium is, or even annual premium is, it's not even in the stratosphere of what the potential payout is for the insurance policy, right? Okay, so that's point number two. Point number three is a lot of other people are adding to that pot, so that helps out to make it a payable or practical event for life insurance companies because they have all the money going into the pot, so they pay out as situations occur. As opposed to you just trying to put your $100 or $200 or whatever into a savings account or an investment account. It's just on its own, right? That's just it's no other people's money going into that pot. So it's working on its own. Okay. And last but not least, the investment account, the gains will be taxable to you one way or another, versus the benefit on the life insurance policy is not taxable. And that's it for today's podcast. I hope that beat that into your brain. And I ask that you forward this podcast to others, so less people will have this question, because it really shouldn't be a question. But I understand people trying to figure out other avenues and see if there's another practical way to another way to skin the cat as far as life insurance is concerned. But it really is not, to tell you the truth, because you can't equate the investments to the potential payout for an insurance policy. Okay. So, hey, that's it. I thank you guys for listening in. I really appreciate y'all for listening in every week, and forwarding my podcast to others, and the new subscribers that are coming on. I really appreciate that. I ask that you forward my podcast to all your friends, your family members, your church members, your coworkers, your employers, everyone across the globe, and ask them to do the same. Hey, say, hey, check out this guy's YouTube channel. All of my podcasts are on my YouTube channel, which is just my name, Ernest Burley Jr. So go on there, subscribe to the channel, and then like the various podcasts and videos that you see on there, so we can, try and make the podcast go viral, right? Make my channel go viral. Okay. So I talk about a wide array of topics. It's not just life insurance. I'll talk about real estate. I'll talk about entrepreneurship. I talk about whether you should buy a vehicle or lease a vehicle, whether you should buy a home or whether you should continue to pay rent or lease, how to improve your credit score, all different types of insurance, not just life insurance. So there's a wealth of information on my podcast, okay, on my YouTube channel. So I ask that you check that out, and that you subscribe to the channel. Ask all of your friends and family, church members, or what have you, to subscribe also, and to forward the link, the channel, to others. Okay. If you want to reach out to me and connect with me, very easy to do. My phone number is 301-262-2600. That's the number to my firm. And my email address is just my first name at my full name.com. So Ernest at ernestburleyjr.com. You can email me, or you can go to my website, which is just my name, Ernest Burley, or ernestburleyjr.com, whichever you prefer. And I have a lot of great information on my website too, questionnaires and things of that nature that I think you'll like. And also just information. It's just great information on the site. I need to tweak my site and put some more stuff on there, but that takes time. So I plan on tweaking the website, but it's some great information on there right now. Okay. And that's it for today's podcast. I'm doing a new thing. I'm not saying my disclosure anymore. I'm putting it up for you to read. So there we go. Look at there. There you go. I'm leaving it up for 5 seconds. That's very clear for you to read, right? 5, 4, 3, 2, and 1. All right. Hey, I thank you guys for listening. I really appreciate it. And I ask that you forward it to others. And, if you have any questions, email me, call me, what have you. I'll be more than happy to help. Hey, y'all take care, and y'all be safe out there.